We might have just witnessed the biggest wealth transfer in history to retail stock traders. This is the longest retail trading buying streak in history at 21 weeks. Not only is it the longest streak, it is also the greatest volume within that time frame. Now, this wouldn't be crazy news if a couple of things weren't the case. The fact that hedge funds and institutional clients are actually at a net negative, meaning they're either selling or they were short, and the fact that the Trump announcements on Liberation Day on April 2nd gave us an almost 20% correction in the S&P 500, where a lot of retail's favorite stocks were at prices that were just frankly unbelievable looking back in hindsight. And this is why 3 weeks ago I said some stocks are approaching the point where it's riskier to miss out on accumulating them than it is to buy them at these levels. And of course, on this very channel, I gave you some of my buys. I gave you Amazon in the 170s, Tesla at 220. Obviously, Nvidia below 100 was a buy. I told you that I never miss the opportunity to buy the SPY and QQQ at every minus 10% correction. And now the retail trader is sitting pretty as the US and China agreed to slash tariffs for 90 days. This was a major breakthrough that came out over the last weekend. As of the time of this recording, Scott Bessent was negotiating with his Chinese counterpart in Switzerland, and this deal came a lot faster than everybody expected, to be honest. Now, it's important to note what the details of this deal is, so we will get into it. Is this pop above the 200-day moving average an all-clear sign? Or have we seen this before, like in March of 2022, when we popped above the 200-day moving average and then fell another 15%? Tesla's finally breaking out after we bought it at 220. What is the target leading up to the robotaxi event? I will talk about some insider options plays that appear to be happening on Tesla and how we could potentially leverage that in order to set up our own long play leading into the robotaxi event. And what is the current status of my hedge that I hedged around the 5,700 area on the S&P 500 and the rest of my stocks? We'll dive into all that, plus what trades and stocks I'm looking at right now. Let's get right into it. So as I said, the US and China agreed to slash tariffs, but let's break down the actual deal here, because obviously it is better than where we were before, which was 125% tariffs across the board, have now been slashed down to a baseline of 10% tariffs plus 20% duties relating to fentanyl. So a total of 30% tariffs that are going to be imposed on China for at least 90 days, and then they'll go back to the drawing board. Now, if you'll remember that on Liberation Day on April 2nd, if you remember what happened, the tariffs were announced after hours. It was like at 4 or 5 p.m. after the market closed. But initially, it was thought that the Trump administration would institute a 10% tariff across the board. It wasn't until that chart came out that showed the reciprocal tariff formula that they used, where the tariffs on some countries were in the hundreds of percentage points, including the tariffs towards China. That is when the market actually started tanking, and we dropped 5% the following day, and we dropped another 6% the day after. So the market was okay, and at this point, digesting a 10% tariff. Now, we'll get back to the charts in a second. Check out the chapters below, but I want to talk about the challenges that are remaining. Does this deal mean that all of the challenges in front of us are gone? Meaning, are the challenges with the stock market finally over? Are the challenges with a potential recession over? What about the bond market? Why are bond yields going up and not down if this is good news? Like I said, I will leave the stock technical analysis for later, but with regards to a recession, no doubt that this kicks the recession can down the road, or at least lessens the odds of a recession imminently. Because if we take a look at this projected map here of how soon we could have went into a recession if the tariffs remain that high, because at 125% or 140%, the tariffs just become an embargo, meaning that that trade will actually be halted. It is less profitable, or it is less worth it for companies to actually engage in trying to buy and sell goods when the tariffs are that high. So we would have likely seen some sort of recession due to a slowdown in goods being transported here, higher prices, a slowdown in the economy, stagflation. So a 90-day pause takes us to August, which means that a summer 2025 recession, because of this, is likely not going to be the case. But this does leave high treasury yields on the table. This is the main focus of the Trump administration. Now, they may have abandoned that in light of trying to appear more favorable because the tariffs were so unpopular. And this is partly why Trump just completely offloaded the responsibility to Bessent and said, I'm good with whatever he decides. And if you look at the Fed funds futures now, it looks like the Fed is even less likely to cut in June or July. The baseline Fed funds futures rate is still projected to be where it is by July, and we don't get a first cut until September. And that's because the deal that was struck between the US and China did not eliminate the tariffs. It just brought the tariffs down to 30%, but it's a guaranteed 30% for at least 90 days. And the comments so far from the White House suggested that 10% baseline is going to remain indefinitely. So the bond market doesn't know how that is going to affect prices and how that's going to affect the economy. And so they're still in the dark about that. And now we have confirmed tariffs for at least the next 90 days and beyond, as opposed to the possibility of maybe eliminating those tariffs altogether. Now, this obviously all depends on the news that we have this week. We do have CPI on Tuesday, May 13th. We have PPI on Thursday, May 15th. We have unemployment claims, retail sales, Jerome Powell speaking right after that on May 15th. And then we have consumer sentiment on May 16th. So with all of that data, where the Fed lands on potential cuts obviously can change. So even though we kicked the recession risk down the road, at least the voluntary summertime recession that was projected by some researchers, if bond yields continue to go up, we are just delaying the inevitable, which still is a recession, but could happen way later than the summer. Because the higher that the yields are, the more pressure puts on the economy, and then things start to break. All right, let's get into the markets real quick. As I said, this was the biggest retail inflow that we've ever seen. And was this the biggest wealth transfer in stock market history? I think so, because we've never seen such a discrepancy between hedge funds, institutions, and retail. And we have stocks like Amazon that were down 33%. Stocks like Nvidia were down 44%. Apple was down 35%. So even though we didn't hit an official bear market in the S&P 500, a lot of our favorite stocks, a lot of retail's favorite stocks were actually in severe bear markets. And this is why I said on April 15th, I get asked all the time, why do I buy stocks? If there is more potential downside this year, simply answered, it's my job as an investor to recognize that at certain levels, it becomes more risky for you not to buy. Am I going to miss Amazon, which was trading at a historically low 15 times cash flow, down 33% from highs? And I gave you guys this play on this channel. Don't make it harder on yourself. Like I always told you, you have the opportunity that's in front of you. You do not know what is going to happen, especially in a policy or headline driven market. You don't know what's going to happen when. What if Trump and Bessent completely give up on trying to lower yields because they realize that it's an exercise in futility and they're just going to let the economy and the Fed deal with it? What if they completely eliminate tariffs, or as we just saw, came to a 90-day pause between the two largest economies in the world? Are you going to miss this opportunity? Now, I can appreciate that maybe not everybody's invested fully in every stock. Me, for instance, admittedly, I wanted to buy Meta. And even though I did get into it below 500, I did not get into it in a full position. I'm not perfect. I'm not Nostradamus. I'm not going to grab the bottom of every single stock, and you are not either. And if we take a look at the comparison between retail traders like us and what hedge funds were doing, hedge funds are going to be scrambling on pullbacks here because they were net short while retail was net long. I've said this to you before, but hedge funds and institutions are just retail traders with a lot more access to capital. They make the same mistakes. They make even dumber mistakes. We saw them get wiped out during the pandemic, some of them, right? And I said here, it's only a matter of time before every contributor on CNBC who said we are mostly in cash and not interested in stocks yet, which we've seen tons of it in April, will magically convert to we've been long stock since April 7th. I said this about 3 weeks ago now. So all that is to say, if you haven't positioned yourself fully yet, don't feel bad about it, because even large institutions and hedge funds are not positioned long either. But I will say, I don't think there's an excuse for not buying anything here. I think there were certainly things that, like I said, were too risky to pass up. Either way, I want you to think about this, right? What if we were about 5% down from all-time highs? Let me measure it here on the SPY real quick. Yeah, we're 5% down from all-time highs. So obviously, we could definitely trickle back to all-time highs, but I just want you to think about one thing. We'll be down 0% year to date on the S&P 500, meaning we'll be flat 0% year to date, even if we trickle back to all-time highs. But think of those that bought here and somewhere here in the lows, right? You are up 20, 25% on the year if we just end the year flat on the S&P 500. That's why it's imperative to pull the trigger on blue chips when we're down 20% at least on the indices. But I think the reason that a lot of institutions were actually waiting to get in is because of valuation. So initially, we started this decline because obviously of the exuberance after the election, the fact that valuations were nearing extreme levels. And so we had this initial drop. The second wave of the drop was because of the outrageous tariff calculations that they came out with initially that have now been rolled back. But if you take a look at the S&P 500 forward PE ratio, right, even after all the earnings that came out, we are basically in the same spot where we started the year. We're still one standard deviation above the 30-year average. The S&P 500 is still in the 95th percentile in terms of current PE. If you look at the S&P 500 earnings yield, you could see that we're in the same place that we were all year. So this drop here, it's not like it reset something where now our valuations are less than they were. We're just back to exactly where we were. So my point is, if we trickle back to all-time highs and we end the year flat, we'll have had 2023 an over 20% gain in the S&P, 2024 an over 20% gain in the S&P, and 2025 basically flat on the year or slightly up, right? That would make sense. And valuations would just still be overvalued. And the valuation reset will come sometime later in 2026. So even though it looks like we're really bullish, even if we get back to all-time highs, we're just flat on the year. So from a valuation perspective, yes, the indices right here are just as overvalued as they were when we started the year. And I think that is what a lot of institutions struggle with. And a lot of money managers like Warren Buffett obviously had raised a record amount of cash before he left Berkshire Hathaway, but there wasn't anything of value that he saw. But when we were down here in the beginning of April, like I said, Amazon was trading at a historically low 15 times cash flow. Google's trading at a less than 17 PE, dropped to 140, currently trading at around 160. I thought semiconductors were attractive once again, sitting at the 10-year trend line, down at the golden pocket of the entire move from November 2022 until July 2024. So you definitely had to pick your spots here. And I personally don't think that we're going to get a third year of over 20% gains in the S&P 500. That would put us at around 7,300 on the S&P, and I don't think anybody thinks that's going to happen this year. So before we get into Tesla, some of the other plays, as well as an update on my hedge, because I did hedge my portfolio with a small percentage of my portfolio. I hedge short at this level here. The plan is still the same, in my opinion. You want to buy these stocks on pullbacks. We had a 2% pullback in the S&P 500 last week. For instance, this pullback here, that is a buying opportunity. If we pull back into this gap, that is a buying opportunity. I don't think we're particularly out of the woods here yet because we are creating a bearish imbalance here. I went over this before, but this bearish imbalance on the monthly chart is something that has always led to lower prices. You can see here in 2022, you can see we have a similar bearish imbalance here. Even back in October of 2018, we created a bearish imbalance. And then the fourth month, we actually dropped down 7%. So unless May closes above this bearish imbalance here, if you pull up a monthly chart and just look at it, you could see that this represents around 5,900 on ES. the S&P 500 and around 20,700 on NQ. If we close above both of those by the end of the month, then yes, I mean, I think that that bearish imbalance is no longer in play. But regardless, I still think that this is a buy on pullback scenario here. I've told you guys this whole time, I do not think we are revisiting 4,800 without a material visual effect on the ground from what the tariffs could potentially mean. And now that we have this 90-day pause and a cap at a 30% tariff between us and China, which means that deals with other countries will likely be more favorable, I do not see the panic ensuing once again to bring us down to 4,800 without a recession. And now that we have a pause in the tariffs, I think a recession is even further down the line, maybe Q3, Q4, or even 2026, in my opinion. All right, so if you look at Tesla, I think there's a play here to get to a robotaxi target of around 370. Remember, I told you that Tesla typically bottoms in April, May, and goes on a run in the summer. Why do I say that? It's because this is the modus operandi for Tesla. You can see here that we bottomed in May, June of last year, and then went on a generational run in July, or not generational, but a nice run in July, going from below 170 to about 270, continuing later in the year to 490. If we take a look at 2023, you could see that we bottomed in April and started rallying up until July 19th. So we went from 150 to $300 in the summer of 2023. And even in 2022, in a bear market, we bottomed in June and we rallied from 206 all the way up to 317 in the summertime. And now we have a robo-taxi event. So in my opinion, if you take a look at the way that the volume behaves on Tesla, you could see that on the up days, you have major volume and then you have volume depletion. And even here, we had major volume. And if we get a pullback with depleted volume, I think there's a long off this level to that 370 level, which is a very plausible target for the June robotaxi event. I'm not trying to trade for the event. I'm trying to trade the lead up to the event, which I think will be bullish. And if you look at the options flow, there was about $3 million of this very unusual option. It was a 370 call expiring June 6th. You could see that it was above the ask and it was unusual. And this is related to what I was talking about here. And you could see the difference between the volume and the open interest. There was only 358 open interest before these call options were initiated. So this is the play that I'm looking at. I actually sent this out in the Discord as well. The exact strike prices, what I'm looking for, when I'm going to enter, etc. I still think Meta is one of the best buys on pullbacks. I still think Google, which to me, this is a major overreaction on May 7th. I think Google will have a massive long opportunity soon. I think once we break out of this inside candle here on Google, there might be a long opportunity, especially if it does something like this and retest that 165 level. I think there is a long opportunity on Google. I told you guys about Amazon, how this was also, in my opinion, one of the cheapest stocks on the market. And you can see now that it traded from 160 all the way to about 209 now. To me, this is a buy on pullbacks as well. I told you guys about ASML the last couple of videos. Obviously, everything is up, right? But I'm going through stocks at which I think are generational opportunities based on the valuation and based on what I see for the business, either in terms of how it generates cash, its growth rate, its valuation, its competitive edge, and monopoly effect in the market. All of the above, right? And obviously the technicals. You can see here ASML sitting at a trend line since 2008. And this is identical to what we saw back in 2022. I think ASML is well on its way towards that $900 to $1,000 mark. If you guys want a series on just the best stocks to buy or the best options plays or a combination of both, maybe, if you guys want a series, let me know in the comment section and I will probably start, if I get enough traction, I will probably start a series on the best stocks to buy and or the best options or swing trades at the moment. And lastly, let's talk about my hedge. So I hedged about 10% of my portfolio at this level here that we just broke out of. Now, I don't particularly think we're out of the woods just yet. And I'm okay hedging that amount because my portfolio is frankly up 25% this year, while most people's portfolios are down. Here is a live login, and you can see that my portfolio today is at all-time highs, made a new all-time high today. You can see there it is there at a new all-time high as of today. And not only that, but I'm most proud of our members' portfolios who are also at all-time high. My portfolio is back to all-time high. Thank you. This was a message that I got today. Another member here is saying they followed, that they're fully invested. And it's not just members in the Discord, even in Twitter. Like I said, I give you guys free game all the time on Twitter, on YouTube. This guy's saying, thank you for teaching me how to fish. I bought the dips and my portfolio is currently at an all-time high, beating the market year to date. Anyway, with that said, as I told you guys in my previous video, I would not naked short the market here. A hedge makes sense, especially at this level. A hedge definitely made sense. I would still do the same thing over and over again, even though my hedge is currently down, but my portfolio is up. The goal with the hedge is you want your portfolio to beat your hedge. Now, your hedge will create a drag on your portfolio. So say that you're in a 10% hedge that's currently 50% down. That's a 5% drag on your portfolio. So you want to make sure that your portfolio is actually up enough to sustain that. Now, with CPI, PPI, unemployment claims, retail sales, and consumer sentiment, and the fact that we popped above this liquidity level here, above the 200-day moving average, I still don't think that we are out of the woods in terms of a pullback. Now, as I said, I don't think we're revisiting 4,800, but I don't think that a pullback is out of the question here. Just like we saw when we popped above the 200-day moving average above these highs in 2022, or in 2018 when we did the same thing, popped above the 200-day moving average above the recent highs, the recent mid-level highs, and then went back to revisit those lows. I don't think a mere pop above this high and the 200-day moving average means that we're out of the woods for a pullback, where we have quite a few things to revisit here on a retracement. We have that gap between April 22nd. Obviously, we have a new gap here. There is a gap here between May 4th and May 5th. So because my portfolio is rocking, I can sustain this hedge. And I rolled it out today another month, waiting to see what the data bears out. Now, when I will close that is likely on Friday, depending on what the market does in response to that data. So in summary, the new 90-day pause definitely kicks the summer recession can down the road. We could see a recession later due to the fact that bond yields are still going haywire. I don't think a push to all-time high is all that revolutionary. It just means that year to date will be flat on the year at 0%. Valuations are still crazy high, so I think that you have to stock pick very carefully here based on valuation. If you need help with that, join us below. I still would not naked short here at this level. Momentum is definitely bullish. I think you should be adding to your favorite stocks on pullbacks. I think there are unique opportunities in certain stocks like Tesla here with a fantastic potential setup to rally into the robotaxi event. And if you want me to do a series on the best stocks to buy and or the best options to buy or the best swings in the market, let me know and I will potentially do that if I have time and if you guys ask enough. Anyway, guys, there is the update for the week. Again, the most retail buying that we've ever seen in history. This might be the best wealth transfer that we've ever seen in history, where retail is actually making a killing above institutions and hedge funds so far. We await a huge wave of news this week that we went over. If you want access to all of my trades, my long-term buys, my analysis, my swings, etc., link is in the description below. I also go live every single morning and trade live. So if you are interested in day trading live with me, that link is in the description as well. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.